Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And yes, it is Wednesday, and your favorite guest, I hear it all the time, Anna. You are the favorite guest in my expert series. So thank you for all you do.
Thank you so much. It's always so good to be here.
Awesome. Well, hey, first episode today. We're 6 weeks away from 2022. So I would like to do some real estate predictions. I'm going to give my opinion. I'll let you go over, under, and share your thoughts. But really, I want to call out all the other real estate channels. Take this list of 6 or 8 predictions, give yours, and then let's see how we do in a year. So all you other real estate channels and posers and, wannabes, let's take this list and see what happens. You ready, Anna?
I'm ready.
I just had to dig that in there, but that's okay. That was my words, not Anna's. Anna is much nicer than I am.
Yes, I am.
So why don't we go rates first, right? We're going to talk 30-year owner-occ. The average rate that just came out this morning is 3.26. I'm going to say that the average 30-year rate, December 31st of 2022, wow, crazy to say. So 14 months from now, is somewhere between 3.8 and 3.9%. So we're up 20%, but we're not quite at 4%. What do you think? Over, under? What do you think?
Yeah, I really think that they're probably going to go up 0.5% at the beginning of this next year.
Okay.
I think that the Fed is going to come out with a strong interest rate increase and hope that they can use that to kind of stave off more aggressive inflation than what we already have. The Fed has basically said that they plan to raise rates 7 times in the next 2 years, right? They're not going to do it like a staggering huge amount, but usually they're going to come out of the gate and try for 0.5%. That would be my guess.
Yeah,
maybe it's a quarter, but
I
think it's probably 0.5% at the beginning of the year, which puts you in the 3 3/4 range.
So just so we're clear, you're saying beginning of the year, let's call it March, April? Or are you thinking January?
I'm thinking possibly January.
Woo, that is much earlier than I thought. Okay, all right.
Yeah, yeah. And I don't know. I mean, I've been wrong before, right? But they've got to do something. And basically, I mean, the approval levels are in the tank. Inflation is the number one thing everybody is talking about. They've got to do something to try to cool off, the demand at this point. And so I think they come out, if not in January, I think next year you'll see at least a 0.5% increase at some point in the year. So, I'm thinking 3 3/4% rates.
So if I said 3.8 to 3.9, you're
pretty close.
Pretty close. All right. That's right. Yeah. Okay. That's number one. Let's do inventory next. Last time I checked inventory, again, national numbers, always check your market. I think nationally speaking, we were at I think the last one was 1.29 million units for sale. So again, I suspect we are up again. December 31st, 2022, I'm going to say we're between 1.8 and 1.9 million units, still below the kind of magic 5 to 6 months. But we're roughly, I guess that's roughly 50% increase from where we are now. What do you think?
I think we're definitely going to see more supply on the market. I haven't really thought about, 50% more houses on the market in a year from now.
Yeah.
I don't know if we go quite that high.
Okay.
If rates stay low, I would probably be under your number in a year, just because I think rates are still so historically low that even if they went up 0.5 point to 0.75%, you're still going to have housing programs that are going to allow you to get into these things, maybe with longer amortization periods. Less money down.
That's on the list. Yes, you're going right where I'm going.
So I think you still have demand that's going to scoop up that supply, in the next year. So I don't know that our supply goes up quite that high.
Okay. So you got the under. That makes sense. I like that. All right. So now let's talk price or value or whatever you want to call it. I'm suspecting that national appreciation, all added together, some up crazy, maybe some down a little bit. We're going to be up somewhere between 10 and 12% next year, down from, I think, 19 this year.
I was thinking probably 7 to 8% increase this next year. So I'd be a little under you as well.
Okay.
but again, we've talked about this so many times. Real estate is so regional, right?
Yeah.
Every area is so different. And so, right now in the major markets where people are moving and where I invest in the Southeast, there's so much demand there and still so limited supply for the amount of demand and people that are moving there, that I think in those Southeast markets, I think you're right. I think you're in still double-digit increases. Okay. In states where people are leaving or it's kind of flat, I'm thinking 7 to 8% increase for 2022.
So if you add all that together, you still think 7 or 8?
I would guess 8.
Okay. All right. I like it. So now a big one that most people don't talk about. This is where a lot of real estate channels miss. And this really came to me after I did my 50-year research that we talked together a lot about.
Yes.
And that is wages. Wages are the unknown thing that people don't talk about, because historically they haven't moved a lot, right? Since the 70s, that they move, but they don't move big. In the 70s, they moved 87% if memory serves. So where do you think wages are? Wages, again, last time I reported, were up 5.1%. I suspect wages, I think we are in a wage spiral, which is not being talked about yet. I think it's coming. I think wages could be up 8 to 10% next year.
Yeah, this is so hard to figure out, and I love that we're talking about this, because these are kind of things you need to think about. How could this impact my portfolio and what I buy if it happens? Yep. And I'm still so surprised that, we have people who are washing dishes being paid $18 to $20 an hour to wash dishes. And we wonder why food costs are going up, right? Exactly. So people are demanding more money because of inflation and their cost of living going up. And if they don't get it, they'll sit on unemployment, right? And so I think that that's going to continue while we have inflation. Wage inflation is going to, come up with that. But at some point, it has to break, Michael. At some point, it's going to cause prices for everything to keep going up, because now that you've got more expensive labor, you've got to charge more for your goods. And at some point, people say, I'm not buying that anymore. It's just flat out too expensive. Yep. And when the demand for the goods that are being provided by the services and the workers comes down, they've got to start laying people off. So either wages will come down for everybody and they'll keep their jobs, or they'll lay a lot more people off. And even though wages are increased, you've got much higher unemployment. So, I think next year you're going to continue to see wages increase. Yeah. Your number's probably not far off. I'd say I'd probably agree with you that that's what we're going to see. Yeah. The question is, across what industries? Is it equal everywhere? Right.
Yeah, well, yeah, they won't be equal everywhere. That's not how math works. But again, when you add it all up together, I think next year is going to be next year starts a slippery slope. I think it starts with wages. It's 8 to 10. But then, as you said, there's a hangover in 2023, but we'll talk about 2023 next year. Yeah, no, that sounds good. Yeah, I think next year, everything's going to go up. Exactly. Demand continues to be high. Costs continue to go up. With that, incomes continue to go up. So I'd agree with you in that 8 to 10%. All right. So now the next one, inflation. Right. And then again, we'll talk about CPI. Again, we both think it's a managed number. CPI came out at 6.2%. I think it peaks next year over 8. And when you add the year together, I think it's got a 6 or a 7 on it. I think and that's a managed number, because I think the real number is over 10%. Yeah, I agree with you. Yeah, I think CPI does continue to go up. And like we've talked about, there's certain things that aren't in that basket of goods that have gone up significantly more, than that 6%-ish range. It's going to continue to go up. So I'd say 8 for CPI, pretty reasonable. Yeah, I think so too. All right. So now some goodies that are going to really kind of play with the supply demand picture. And you've already hinted at a couple of them. Will we get a first-time buyer program? And my answer is yep. Yes. Yeah. Yes. Yeah. Yep. And not only first-time buyer program, but because rates are going to start tricking up, right? Banks still want to get you to keep buying housing. Fannie or Freddie, I think both of them actually came out today and said now they'll do $1 million loans. I saw that. $1 million loans. Let's get you a loan to buy a more expensive houses as the housing value going up. Oh, so lots of programs to incentivize you to continue to buy houses, even if rates go up. Yeah. So again, this is all leading to net new demand, not net.
Correct.
Again, folks, I had a rant the other day because I was trying to build 8 affordable single family homes. And because I'm in California and all these fees and all this stuff, I would end up losing $30,000 to $40,000 per house. It's like, no wonder nobody builds affordable housing. Anyways, I digress.
Right. But yes, and that's part of why I agree with you that housing values will continue to go up.
Yeah.
Or a lot of people think that values are just going to crash because rates are going to go up, right? Rates are going up, but they're still historically extremely low.
Yeah.
And as long as bankers give you a yes answer, you will still chase that more expensive
Absolutely.
house, get a good payment, low down payment, and still be able to afford it. And so you're going to have continued demand for housing.
Yeah, no question. Foreign buyers. This is something that just hit my radar the other day, right? We 20-month travel ban has been uplifted or released or whatever the right word is. And I didn't realize, I did some research. Foreign buyers total purchases are down 50% from 2019. So I suspect, total value, right? Some of that's trophy assets and all of that. But again, throw it all in the pile. It's half as much as it was. I think there's going to be a wave of foreign demand next year. Both kind of class A, park your money, don't even look for cash flow because they're trying to save their wealth. But again, foreign demand will double or triple perhaps. Cause again, 100 to 50, 50 to 150, it's a triple. And that's just more demand.
Yeah. That would not surprise me at all. I'm really surprised. I had not seen the statistic anywhere and I wasn't looking for it, but I certainly didn't see anything about, foreign purchases being down 50%.
Yeah, total
that really
value
surprises me.
Yeah.
So, but again, to your point, without being able to travel and see properties, I guess people are buying less. So, I think, yes, foreign investors continue to flock to real estate. Especially with inflationary times.
Yeah, with rest of the world being kind of wonky. Think about if you're a wealthy person in China right now with the whole kind of attack coming on. Jonathan Twomley told me that back in the 80s when he was in Japan, the rich would have suitcases of money taken on airplanes to, get money out of there. So crazy stuff. All right, next.
Crazy.
Wall Street. I think Wall Street has proven that single family market is awesome. It has given them, at least in 2021, the highest risk-adjusted score at over 6%. I think Wall Street's appetite grows in 2022. If you listen to D.R. Horton, I think it was D.R. Horton. It might have been somebody else, but I think it was D.R. Horton. 20% of their supply next year is already bought by build-for-rent communities from Wall Street. So I think Wall Street is a increased buyer next year, not less.
100% agree with you. Yes, there are some major players and major funds that are buying up homes. And to your point, the build to rent model is very, very attractive, and something they're doing a lot of all over the country.
Yeah. All right. Builders, right? Builders are going to increasingly, i.e. feed Wall Street. It's easier. It's one dime, right? Dealing with 100 individual buyers versus one Wall Street hedge fund, a little bit different. Just a little bit, right? So they're going to increasingly feed that. And also don't have enough lots. Labor still a problem. Supply chain still a problem. They are not going to deliver more houses. They're going to, it's just going to be slower than we would like.
Yeah, I agree with that. And I think that when they do, the prices are going to be, priced at a premium. There's no more of these like huge incentives to come get your new property that we're building for you, 10% off of all your amenities plus, negotiated low rates with the bank. They don't need those incentives.
Nope.
And there's too much risk for them because they don't know what their cost is ultimately going to be with these supply chain issues.
Absolutely. Then we talk about iBuyers. Obviously, Zillow is in the news and getting out, but that doesn't mean iBuying is bad. I think with the real estate market slowing down, iBuyers profits shrink and they're a little bit less active, but they don't go away. They are still a force in many markets. That's definitely region based.
Yeah, I agree with you. And I've seen some articles. I just really skimmed them, but others like Redfin, for example, are like, just because Zillow did it poorly doesn't mean we're not, doing it. So we still have a better business model than they did.
And then the last one, do you think we see the formal introduction of a 40-year mortgage for owner occupants next year? This
Probably
is
yes.
Oh, you're saying yes. Oh, my core wants to say no, but I think you're right. I think it happens.
Yeah, if you really watch carefully what the politicians are saying is important to them, it's affordable housing, right? And so the way that they make housing affordable when they can't change your prices is they make your payment lower. So they try to get you into programs, they have to, that allow you to still get a mortgage, even with prices going up. And the way they do that is they lower your payment somehow. And it's either a lower down payment or a longer amortization period or both. We already have low down payment programs, FHA, USDA. And so we hear a lot about affordable housing, affordable housing. It's like the drum that's continuing to be beat, so progressives especially really are pushing hard for new affordable housing programs.
Yeah.
So because it's top priority for them, I think they work out the 40-year mortgage with Fannie and Freddie.
All right, folks, if you are a real estate channel, there is your list of predictions. Let me know what yours are. Post it, tag me. We will see. I would, if you want to put some money on it, let's put some money on it, give away some money to charities. Anna, thank you for playing along. How can people follow you?
Great. You can find me here every Wednesday, and you can follow me on Facebook, Instagram, and LinkedIn at Anna, REI Mom Kelly, and my website, reimom.com.
Thank you, Anna.